Today, we're diving into a fundamental challenge facing the entire Nepali banking sector. And look, this isn't about the usual ups and downs of the market. We're talking about a massive regulatory shift called the Basel III Endgame, and it's set to completely reshape the future of bank profitability in Nepal.
And that, right there, is the perfect way to think about this. What we're witnessing isn't some temporary storm that's going to pass. No, this is a deliberate, foundational restructuring of the very DNA of how banks in Nepal are supposed to operate and, frankly, how they make money.
So here's how we're going to break it all down. First, we'll look at the regulatory storm itself. Then we'll get into a key mechanism we're calling the capital vice. After that, we'll see the guaranteed profit squeeze it creates, how this signals the end of an era, and finally, the stark choice that every single bank is now facing. Okay, so the heart of the issue is this. The Basel III Endgame, which the Nepal Rashtra Bank is pushing for to create stability, actually creates a fundamental and unavoidable conflict. It puts the regulator's goal of a crash-proof system on a direct collision course with a bank's most basic need, to generate a profit for its shareholders.
You see, for decades, the playbook for Nepali banks was pretty straightforward. Keep your capital base as lean as you legally could and just grow your loan book to drive up profits. Well, this new regulation takes a sledgehammer to that exact model. It's forcing banks to hold way more capital against their loans, creating what feels like a tightening capital vice.
So let's talk about how this vice actually works. To really get a feel for the pressure banks are under, we have to dig into the mechanics behind it. And it all boils down to how risk gets calculated.
The key concept you need to understand is something called risk-weighted assets, or RWA. Just think of it as a way to put all bank assets on a level playing field, risk-wise. For example, a super safe government bond might have a 0% risk weight, but an unsecured personal loan, that could be weighted at, say, 125%. That means every single rupee of that loan actually counts as 1.25 rupees when figuring out how much capital the bank needs to hold. Now, the Endgame tightens this vice in two very specific ways. First, it jacks up the risk weights on the bread and butter of Nepali banking, things like commercial real estate loans. Second, it forces every bank to use a standardized approach. What does that mean? It means the regulator, not the bank, gets to decide how risky an asset is. Banks can't use their own, often more optimistic, internal models anymore. The result? A huge forced inflation of a bank's total RWA.
So, with that backdrop of massively inflated risk, let's look at the guaranteed financial fallout. And I want to be clear, this isn't some theoretical prediction. It's just simple, unavoidable math. You know, the ultimate report card for any bank, the number shareholders care about most, is its return on equity, or ROE. It just shows how well the bank is using its owners' money to make a profit. For years, the whole strategy has been to keep that bottom number, the shareholders' equity, as low as possible to make the ROE look great. Well, Basel III completely flips that strategy on its head. And this right here shows you exactly what I mean. Take a look. Before the endgame, a bank with $11 billion in equity and $2 billion in profit has a pretty healthy 18.2% ROE. But now the new rules force it to hold more capital, let's say $13.2 billion, against the exact same assets. So even if its profit doesn't change by a single rupee, its ROE automatically collapses to 15.1%. This isn't a maybe, it's a mathematical certainty. And what this means is that the old go-to solution, hey, let's just grow the loan book more aggressively, is now a trap. In this new world, every new loan you make eats up a much bigger chunk of your capital. Growth actually starts consuming your capital faster than it can generate profits, creating a really dangerous, vicious cycle. But you know, this goes so much deeper than just numbers on a spreadsheet. What we're really seeing is a profound philosophical shift in how the entire Nepali banking system has to think about and value risk. For generations, Nepali lending was built on one simple principle: collateral is king. If your loan was backed by a nice piece of land, it was considered safe. Period. Well, that paradigm is now basically obsolete. The new rules are all about the transaction itself. They penalize entire categories of loans, like commercial real estate, almost by default, no matter how good the collateral is. What matters now is one thing: can the borrower's business actually generate cash flow to pay back the loan? And as if all that wasn't enough, they've added another layer of pressure. The rules now introduce a brand new mandatory capital charge for operational risk. This is the risk of things going wrong inside the bank. We're talking fraud, cyber attacks, failed systems. It's basically a new tax on a bank's capital, forcing them to park precious equity just to cover their own potential mistakes. So you add all this up, the capital rise, the collapsing ROE, this huge philosophical shift, and it forces every single bank in Nepal to a critical crossroads. They're now staring down a stark strategic choice, and there are really only two paths forward.
And these are the two camps that are going to define the industry for the next decade. On one side, you have the consolidators. These are the banks that will cling to the old lending model, fight tooth and nail over shrinking margins, and probably be forced into defensive mergers just to stay afloat. Then you have the pivots. These are the ones who will accept that the game has completely changed and start doing the hard work of reinventing their entire business model.
So, what does a pivot actually look like? It means building real, sophisticated capabilities in areas that are light on capital and heavy on fees. We're talking about things like high-end wealth management for Nepal's growing affluent class, real corporate advisory for mergers and capital raising, and complex transaction banking that's way beyond simple letters of credit.
But let's be absolutely clear about something. This is not the easy path. This pivot is brutally difficult. It requires massive upfront investments in specialized talent and new tech, all of which will probably hurt profits in the short term. It demands a complete cultural overhaul, turning old-school loan officers into trusted advisors. And more than anything, it requires real, sustained conviction from the very top of the organization.
So the Basel III Endgame isn't some distant threat on the horizon anymore. It's here. It's the new reality, and it marks the closing bell for an entire era of Nepali banking. That leaves us with the one critical question for the entire industry. Which banks will have the leadership, the vision, and the sheer conviction not just to play by the new rules, but to change the game entirely?